Greg here with Market Update. Okay, so as we've mentioned before in previous market updates, this time of the year generally is very quiet. A lot of the traders are starting to look forward to Christmas, the end of the year, and starting to wind up for the year. But having said that, at the moment the markets are still moving and we're still seeing some very important things happening in the markets. So let's recap what happened last week, because some important things that are moving markets happened last week. Last week was a big week for global central bank meetings. Now, the first central bank that kicked off those meetings was the Reserve Bank of Australia, the RBA. Now look, they did not cut rates, that was expected, but the language that they used is that they were, in the statement, that they were open in the future to cut rates if the data warranted that. So they are now data dependent. 2 days later, we had employment data out of Australia. That employment data, the monthly data, came out much better than expected. The market was expecting unemployment to go from 4.1%, marginally up to 4.2%, and it actually came much lower than expected. A 12-month low for unemployment, below 4% at 3.9%. So you can forget about any rate cuts anytime soon by the RBA, because that is absolutely fantastic employment data. Aussie has been struggling below 64 cents. I would imagine at some stage the fact that the RBA is one of the only central banks globally not cutting rates should support the Aussie at some stage. So I'm not sure if I'd be selling the Aussie down below 64 cents. Anyway, let's move on. We also had the Swiss National Bank, the SNB, cut rates by an aggressive 50 basis points last week. We also had the Bank of Canada, the BOC, also cut rates by an aggressive 50 basis points last week. We also had the European Central Bank, the ECB. Now they cut rates by 25 basis points, but the ECB did consider 50 basis points. And certainly the ECB moving forward has not finished cutting rates. Look, the key takeaway from this, what happened last week with the global central bank easing, especially the aggressive central bank easing, is that a lot of these central banks now are looking at their economies. They are seeing growth slowing quite considerably, which they're worried about, and they've also got inflation at target. So for them at the moment, they are more than happy to ease rates and continue to do that. Now, obviously, with especially those central banks that are aggressively easing, those 50 basis point cuts, we're seeing the interest differential between those central banks and the Federal Reserve widen. Now, one of the main things that we see currencies trade on is central bank and interest rate differentials. Now, when those interest rate differentials blow out and widen, and especially when they widen in the favour of the US, that is a positive for the US dollar. So last week, what did we see? We saw the US dollar have a good rally. The dollar index basically rallied every single day last week. And we saw the dollar index, back up to 107. Recently, in the past month, the dollar index has traded as high as 108. These are multi-year highs, basically sitting above a multi-year range as well. So you've got to be mindful that this US dollar rally could potentially break higher again at some stage and gain more momentum. One of the other things that has been driving the US dollar, besides the central bank meetings and these aggressive central bank global cuts, is the fact that US bond yields also had a fantastic week last week again. US 2 yields and 10-year yields, which the market is focused on, were up about 20 basis points. So we've got US 10-year yields back at 4.4%. The highs that we saw, like the 6 months highs for those, are around about 4.5%. US dollar tracks US bond yields very closely. That's another factor why we're seeing that US dollar rally as aggressively as it has. The bond yields are rallying on the basis that the US economy is still showing signs of life. It is outperforming other global economies. So it is a buy US, sell the rest of the world story in the markets at the moment. Very hard to go against that trend. Okay, so this week we continue with the global central bank meetings, and on the 18th on Wednesday we have the biggest central bank meeting, the one everyone's been waiting for. That's the Federal Reserve. Now the market does expect the Federal Reserve to cut rates by 25 basis points, so that is not going to be a surprise. It's not going to move markets, it's not going to worry markets. So that they will cut rates from 4.5% down to 4.25%. Now 4.25% is well above most other central bank rates at the moment, and as we were saying before, it's the interest rate differential and the fact that the Fed is never going to get as low as these other central banks. That is keeping this US dollar big. The other important thing to note about this meeting is that once every quarter the Fed releases its dot plots. The dot plots basically is where every single Fed board member gets to forecast where he sees interest rates in the following year, 2015, and early 2025, and also into 2026. Now, when the Fed first pivoted, and we saw the market and also the Fed members give their expectations of where they expected rates to be in 2025. The Fed members saw 1% of cuts in 2024, which pretty much we're going to do on the 18th. But they also saw another 1% of cuts into 2025. This dot plot will show that is no longer the case, and we will probably see the Fed members pencil in only 2 rate cuts are expected for the whole of 2025. So what we are seeing from the Fed now is that the Fed has essentially probably done most of its easing after we get this Fed rate cut on the 18th this week. And then moving into 2025, we will see the Fed potentially pause and only see a maximum maybe only 2 rate cuts. Now there is also thoughts in the market now that and a chorus growing for this line of thinking. That potentially the Fed may even be done cutting even after this cut on the 18th. And the simple reason for that is that we just saw inflation numbers out last week, and inflation for the last 2 months in a row has actually increased. So we've seen inflation go from, in October, 2.4%, into November, 2.6% for headline inflation, and then marginally up again. There's December numbers we saw last week at 2.7%. So inflation's actually been going away from its 2% mandate. We've also got core inflation sticky at 3.3%. So next year, obviously Trump takes office, he's going to reintroduce tariffs, super inflationary, and potentially that could put at least 1% on inflation. So we are moving well away from that 2% mandate from the Fed. And depending on exactly what inflation does next year, but we may not be actually talking about rate cuts next year by the Fed. We might even be talking about rate rises. Okay, I know that's a little bit early to start talking about that, but if inflation's moving away from 2% and is continually marginally going up, the reasons to cut just are not there. Okay, so yes, that is key takeaway from everything we've just talked about is that this has kept the US dollar strong, and it's broad-based strength. So it doesn't matter what currency pair you're trading. The US dollar has been bid. The last central bank meeting that we're going to have for the year is straight after the Fed, and that is the Bank of Japan. Look, the conditions for the Bank of Japan to hike are certainly there now. They have got inflation above 2%, and it's been sustained above 2%. But the market is expecting on Friday 80% probability, so very high, that the Bank of Japan will not rush into raising rates at this meeting on the 19th, but potentially on January, when it meets in January, and in March, that's when we'll potentially see the rate hikes. So the Bank of Japan, in the news conference afterwards, may actually start to prepare the market for those rate hikes. Bank of Japan is probably one of the only central banks globally that still surprises the market. So most other central banks, there is a lot of transparency. So when we have a central bank meeting, we know exactly whether or not they're going to cut and by how much. So there is a possibility that the Bank of Japan could even hike rates. So I would not be short dollar yen come the 19th, that Bank of Japan meeting. For the simple fact is that they're a central bank that can surprise, A, and two is that if they don't hike, I would imagine that they will certainly make the case for hiking and prepare the market for hiking. Dollar yen's had a good rally in the last week with the rest of the US dollar, up a good 300 plus points, but anywhere towards 154 plus to 155, certainly would not be getting fresh long and would potentially looking to be short going into that Bank of Japan meeting. Look, some other markets that are moving at the moment, obviously, look, Bitcoin is still getting a lot of headlines. It's now still trading above 100,000, it's 103, the record high was there at 105. Still seeing a lot of positive headlines for Bitcoin here in Australia. AMP, one of the biggest $1 billion superannuation funds, end of last week, came out and told the market that they had actually been buying Bitcoin via Bitcoin futures, but having a big institution, a big superannuation fund, being involved in Bitcoin now certainly gives it more legitimacy, and also the fact that AMP's come out to do that means that no doubt some other big superannuation funds aren't far away. So yes, that has kept Bitcoin bid and above 100,000. And no doubt, look, we're no doubt going to go bid into the end of the year. Trump gets elected same day. We've talked about this before. Paul Atkins, the new SEC chair, takes over. So let's see how we trade post the 20th of January. Just lastly, it's also Bitcoin related, but MicroStrategy, the firm that Michael Saylor runs and basically owns the most Bitcoin in the world, has been added to the NASDAQ ETF. So that's another positive for obviously NASDAQ and for Bitcoin, more legitimacy. But it also means now that when you are trading NASDAQ, you are trading exposure to Bitcoin. So further out, we may see some more increased volatility on this MicroStrategy inclusion. Okay, look, we'll lot on. Good luck with your trading, and we will catch back in with you shortly.